Well, many investors are wary of the current economic environment, and so they're torn between A, sitting on the sidelines and playing it safe with a low interest-bearing account, or B, investing in stocks they might consider risky. So what should you do? My next guest, Lawrence McMillan, has written this book. It's called Options for Volatile Markets. In it, he outlines strategies that just might work for you. Good morning to you, Larry. Good to see you.
Thanks for having me, Danielle.
Thanks for being here. Why'd you write the book?
Well, very simply, just to show the average investor how they can invest in a volatile market. The strategies we recommend reduce risk and also reduce the volatility of your portfolio. The book starts out right at ground zero, though, all the definitions and everything, and then we move then later, into the strategies themselves.
Well, let's talk about that as far as definitions. What is the difference, Larry, between a risky speculator and a conservative one?
Risky speculators buy the hot stock, something your barber told you about, or, you tip.
Hey, did you hear about that? Such and such and such.
Exactly.
Like, oh, let me go invest in that.
Whereas a conservative investor usually buys stocks that are in maybe the S&P 500 index or one of the Dow Jones 30, et cetera. And in the context of what we're talking about here, we talk about call options. And a call option is the right to buy stock at a certain price for a certain length of time, so 1, 2, 3 months. Risky speculators buy these options hoping to make a fortune, usually end up losing money. But conservative investors sell these options against stock that they own.
This got me to thinking, because you're thinking about, the economy and the recession, and isn't it justifiable that kind of given the current economic conditions that people are just by nature being more conservative these days in terms of where they're putting their money?
Oh, absolutely, you're right. I mean, there's the European problems, even China, Iran, who knows, all these various things. Plus, domestically, we've got, the housing market still hasn't really recovered, and the unemployment rate is still pretty high. So yes, it is a time to be investing conservatively.
So what is the primary strategy that you talk about in the book?
Right. Well, we call it covered call writing. It's not that we call it that. It is called covered call writing, and it's basically you sell these call options against stock that you own. So the stock covers the call. And it's a really nice way of reducing the risk of your stock ownership, because you get the premium from the sale. And you do give up potentially some of the gains in the stock. So if the stock goes up far enough, you sell it, but you would still make money. The stock would go up, then you would sell it. So it's really an excellent way to generate income from stocks, even if that stock doesn't pay a dividend.
So a little more example of how this works. I mean, how does it ultimately then reduce the volatility of a portfolio of stocks? Okay,
well, you sell these calls and you take in the money from them. So if the market goes down, you've got that money. So you don't lose as much as, say, the regular stock market or people who didn't sell calls. On the other hand, if the market makes a huge jump in price, goes way up, you will sell some of your stocks because you wrote these calls, and so you wouldn't make as much. So the biggest gains are not there, the biggest losses are not there. But most of the time, stocks really don't go a whole lot of anywhere in a very short period of time. And that's where you really come out ahead here, because you're generating this income all the time.
Which is nice. What do you do then with the money that's received from selling a covered call?
Well, you can take it right out of the account, just like
you can take it right out.
Exactly. As long as you leave the stock in the account, you can take the money out. So a lot of people just use it as extra income. And some people leave it in there and eventually it accumulates and they buy another stock with it. Most of the clients we have, they just take it right out of there, just like a dividend.
Now, I know in later chapters of the book you talk about other strategies that a conservative stock owner can use to kind of reduce their risk of volatility of a stock portfolio. Let's talk about a couple of those.
There are things called put options as well, which allow you to sell stock. So a conservative investor can buy a put option to hedge his stock with. And then in recent years, they've actually come up with volatility derivatives. So you can actually trade volatility directly against your stock. So if you have a large portfolio of stocks, maybe you'd want to buy some volatility just to hedge yourself. But that's the last chapter of the book.
Yeah, that's at the very end there. But what you've talked about, I think, is very interesting for people who are looking to invest and do want to do so conservatively. So great information, Larry. Thank you so much for coming by and sharing it with us this morning.
Thanks a lot for having me.
And once again, the book is called Options for Volatile Markets. For more information on Larry or the book, please visit the website optionstrategist.com.